Hi, I'm Rick Kaler. Thanks for joining me today. Well, when Susan came into the world in 1974, of course her parents wanted the best for her. At that time, one of the loving things that many parents did for their children was to purchase life insurance policies on them. Parents had two reasons usually for purchasing these policies. The first was to pay for a funeral if the child was to die prematurely, and the second was to build a little nest egg that the child might use later in life for college or a down payment on a home. Now, when Susan was 6 months old, her parents bought her a $2,500 whole life policy. That amount would have actually purchased two funerals in 1974. The premium, it was $38 a year. If we adjust these numbers for inflation, they're comparable to a current policy with a death benefit of $12,000 and an annual premium of about $180. The agent explained they could purchase term insurance on Susan for $12 a year. But that would be money down the rat hole, so to speak, so it wouldn't accumulate to help Susan with a down payment on a house or college tuition. But for an additional investment of $26 a year, Susan's policy would grow and accumulate dividends, giving her the cash that she would need for that down payment. Susan never did tap her policy for college or her first home. Instead, she let it grow and accumulate, doing nothing but toss her annual statements into a file folder. Even so, Susan's parents dutifully paid that $38 premium every year. Well, this year, Susan became curious about her policy and dug out her most recent annual statements. She learned that if she died today, her death benefit would be $2,945.90. This was the original $2,500 death benefit, plus accumulated dividends of $445.90. That had accumulated over 39 years. If she wanted to cancel the policy, the company would send her a check for the surrender value of $1,120. So Susan got curious. She grabbed a calculator and figured out that the total premiums paid over 39 years were $1,482. At first glance, it would appear the policy may not have been a great investment since the cash value of $1,120 was less than the sum of the payments. But to make a fair comparison, she needed to subtract the cost of providing the insurance. That was that $12 a year that would have costed by the term insurance, which was a total of $468. Only $26 a year, or a total of $1,014, had gone toward accumulating the cash value. Well, it was actually the $1,014 that grew to $1,120, which represented an annual return of 0.25%. So Susan was curious again what the $26 a year might have grown to if her parents had purchased only the term insurance and invested the difference in a stock mutual fund. She did some research and found there was a reasonable chance stocks might have returned 8% annually, meaning she would have $6,212 today versus $1,120. Well, that would make a down payment on a small house and might pay for one semester of tuition at a state school. Death benefit of almost $3,000 from the term life policy would pay about half the cost of a proper funeral. Susan realized canceling the policy and adding the money to her investment portfolio would probably be the best financial decision. Interesting enough, though, she was surprised at how difficult it was to carry out that decision. The policy had just always been there. Canceling it felt like rejecting a loving gift from her parents, especially since her father had died a few years earlier. The policy was just part of her security, and giving it up was an emotional as well as a financial decision. Susan told me it was like saying goodbye to an old friend. Thanks for joining me.